Welcome to FinanceFeeds podcasts. FinanceFeeds is the world's premier interactive Forex industry news source, providing the latest insights and current affairs from within the online trading industry worldwide. Enjoy our latest podcast episode. Hi, everyone. Welcome back to another episode of FinanceFeeds podcasts. My name is Nikolai Isayev. I'm Editor-in-Chief of FinanceFeeds. Joining me today on the show is Matt Barrett, who is CEO and co-founder at Adaptive. Matt, thanks for joining us today.
Great to be here, Nick.
Matt, I wanted to start out by asking you a little bit about your professional background. Perhaps some of our listeners may not be acquainted with you. Can you give us a brief rundown of sort of your personal history and your experience within the industry?
Absolutely. So I'm originally from New Zealand. I grew up in New Zealand and went to university there. I did a master's in computer science. So I came out of that around 2004 and moved to London straight away. So I moved to London in 2005 and went straight into software development, software engineering. I worked in London for 5 or 6 years outside of finance in a range of different jobs as a software engineer, some quite different to finance and some with a lot of crossover. One of the roles I did that was quite different was in educational learning and management. So I built some early learning management software for higher surgical training in the United Kingdom, which was very interesting. And some that was far more related to finance was spending some time working in television. Television, from a software perspective, has a lot of similarity to finance because it's all about real-time constraints, high availability, reliability, quality engineering, a focus on what the infrastructure can provide and making sure you get the most out of it to provide the best experience for the users of the software on top of it. Then in 2010, I got my first job in finance. I started working for a consultancy called Lab 49. I worked for them for 13, 14 months. Then I went to Barclays for a while. And then in 2012, I started Adaptive with some colleagues that I had met when working for Lab 49 a year or two ago.
Great. You have a very rich history in the engineering and software. Our conversation today really is about trading technologies, I think, if we can call it that. And I wanted to start out by mentioning that, I noticed that Adaptive really went all in on what we call the cloud. Since your company acquired RealLogic, the developers of Aeron, and this was back in 2022, if I'm not mistaken.
That's right.
Can you tell us what Aeron is and why you believe there will be a mass migration of institutions' trading systems going to the cloud in the future?
Absolutely. So firstly, what's Aeron? So Aeron is open source. Aeron is focused on being a high-performance, low-latency messaging solution. In the finance world, that means it is similar. It sits at a similar level of the stack as some proprietary messaging technologies like Solus or Tibco or 29 West, which is now owned by Informatica. So you can think about it as providing the role of low-latency, reliable connectivity between different machines to enable people to build higher order systems on top. It was started 10 years ago in the open as open source software by Martin Thompson and Todd Montgomery, who themselves had very storied histories in capital markets. Martin Thompson was the CTO and co-founder of LMAX, which is a well-known exchange. Todd Montgomery himself was the CTO and co-founder of 29 West, which is a very successful low-latency messaging system. So those gentlemen were funded by another firm to build a non-proprietary modern messaging system, and that is what they did. And it grew over the 10 years to today, and then over the 7 years until when we acquired it in 2022, as you point out. One of the things we say about Aeron is that it is cloud native. That means that it's a low latency messaging solution that is highly performant on the cloud. Why is that interesting? Well, we think that there's going to be a mass migration of institutional trading systems to the cloud because of the benefits of the cloud to the market participants themselves. And to justify that statement, you have to step back a little bit and think about the history of connectivity, of wiring up machines and having a global communications network designed to facilitate communication between parties. I say that in a slightly tortured way because I really want to avoid saying the word internet. Everyone thinks that the only globe-spanning telecommunications network is the internet, but actually, finance, capital markets, has a shadow system. It's similar in scope in that it spans the globe. It's dissimilar in complexity because it's just used for one specific industry vertical. It's used for capital markets, execution and facilitation of trades between counterparties. But it really does have a lot of the same features, right? There's telecommunications involved to connect different data centers together. There's hardware that sits in data centers. There's software that runs on top of it. Like, it looks like today's public modern internet, except that there's nothing cloudy about it. It's all manually configured. There are people that go out and plug cables in. When you sign up with a capital markets focused data center provider, they typically have their own racks or their own data centers, and they send people out, and you send contracts in and you tick boxes, and it feels manual, right? But when you speak to a cloud provider, well, firstly, you don't speak to them. You insert a credit card and you push a button and you have some infrastructure deployed for you. And you can click another button and it can be redeployed anywhere else in the globe. And you don't really pay any money up front. So it's all software and communications and hardware and technology. But the way you access it is very, very different. And if we look at, since the early 2000s, the way that we have now these global software businesses that scale the planet, the Netflixes and the Spotifys are good examples. They got their start on cloud infrastructure, and it would have been difficult to build those firms if they hadn't been able to leverage in a very capital efficient way the globe spanning resources of those cloud providers. Now, the capital markets ecosystem has existed in this parallel track for 30, 40 years. And what we think is that the cost benefit ratio is getting so great that capital markets participants are going to move over to the public cloud infrastructure rather than stay on their own separate track, which has a lot of cost and complexity embedded in it because it doesn't have the scale that the cloud providers have been able to pour into making their infrastructure trivially easy to use, to scale, to rent. And it's just sort of like the natural market forces that are going to force people to use the best service offering out there. Doesn't mean it's going to happen overnight. Doesn't mean there isn't a lot of things that need to be done on the road to get us there, or the overall industry there. But that's the general direction of travel that we see. And one of the reasons that we're such big believers in it is that we have been building trading venues for our clients for the last 12, 13 years. And one of the things that is true is that those firms that target the cloud have more connectivity with clients or other venues or counterparties than firms that target traditional co-location facilities. And it's not because everyone else is running in the cloud. It's because the difficulty of getting connected in a physical co-location center is significant. The difficulty of connecting to the cloud is really just clicking a button. It surprises me, but it is true. The organizations that we're dealing with have figured out how to connect to the cloud very quickly, and it is still more difficult to get an interconnection provided between counterparties in a physical data center. So we think the general direction of travel is this.
I would say that I definitely agree with you, but aren't there certain challenges in this besides, like you said, there have been improvements or there have been developments where
Yep.
this process has become a lot easier. But when I think of, again, this word, the internet, right, the public internet, correct me if I'm wrong as a layperson, when a large financial firm moves over into this public space, let's call it the public space, and connects to the different cloud systems, aren't there implications like security and things like that? Because again, you are now on the World Wide Web, and hence you may be subject to some sort of data breaches or security issues or something like that.
Yep.
Again, as a layperson, that's one of the things that comes to mind, and I'm sure there are solutions to make sure that none of this impacts the data flow, the transactional flow, and day-to-day operations.
So it's a good point. Going back 15, 20 years, the first versions of, or the first iterations of the public cloud were primarily concerned providing, let's say, web servers, public web servers, to allow the internet to access, right? That's how they were characterized. But in the last 10, 15 years, we've seen a real shift in what is the primary use case of the public cloud. And it's not necessarily about hosting public web servers anymore, although that is still a large part of it. It's as much about moving what was in your private data center into a private part of the public cloud. And that privacy is guaranteed through the physical controls that the cloud providers have around their physical data centers, very impressive physical controls that they have in place,
Mhm.
a range of security policies and processes, cryptographic security that ensures that your data is encrypted when in motion between different servers running in the public cloud, that it's encrypted when it's at rest sitting on a hard drive or on an SSD or in tape storage, and that those keys remain private to you, and that you have the ability to invalidate them should you wish to destroy that data. And you also have the ability to, if you protect your key, you are guaranteed that no one else is able to access your data through fair means or foul. So the cloud providers have spent a lot of time and money making sure that you can get the security guarantees that you had previously because you owned the data center replicated in the public cloud. And the cloud providers would argue that actually the security properties are stronger because they do a better job of physically securing, as one example, the data center than you ever did. You were always at risk of someone walking into your data center and stealing some hard drives. Because did you have a great physical security model? Probably not. The cloud providers have a very good physical security model. So that's the argument they would make. And we see it winning. That argument is winning over time, right? We built a major fixed income trading platform for a major US financial institution a few years ago that went on to run on AWS. And when they first started building, the feedback they had from their market participants, from the clients that they wanted to serve was, we're not ready yet to send our order flow into the public cloud. 2 years later, those same firms were saying, it's fine now. Absolutely. You can please move into AWS. We trust it. We absolutely believe in it. We're doing a lot in AWS right now. Please go ahead, right? It's a shift that has happened gradually and now happens more and more.
And I guess another quick follow-up question on this with respect to latency and speed, right? So if we speak about the legacy systems or the data centers that we have across the world, they're obviously interconnected, but it's a closed environment, right?
Yep.
I guess
Yep.
my question is, when moving into the public cloud, are you at mercy of any kind of latency or a speed? I wouldn't say issues, but performance wise, when we talk about the public cloud providers, again, they silo individual systems and hardware and connectivity for their individual clients based on their needs, right? So, in other words, yes, you might be part of a bigger, what we may call public ecosystem at a cloud provider, but for each individual project, each individual firm, that may be something that's privately siloed. From a security standpoint, we just
Yep.
discussed, it's encrypted. And then from a speed or performance perspective, there's also something there where, again, we ensure that there won't be any issues or hiccups with respect to the speed of, let's say, data transfer or the speed of execution of transactions. Because if we talk about capital markets, it's usually a two-way street, right? It goes one way and then it has to come right back if we're talking about a trading platform and a server
Yeah.
elsewhere and things like
Yep.
that.
So that first part of that discussion was really about like policy and how you
Mm-hmm.
can prove that you have security and so on and so forth, and governance and sovereignty of data. Second part, which you're asking about now, is about the engineering constraints that come from being in the cloud, right? And that's a very interesting topic to unpack. One of the points I would make to help people think about the overall direction of travel here is that CPUs, so the central processing unit, that is the thing that if it gets faster, you can process more transactions in a second, fundamentally. Those used to be driven primarily by people buying computer games. So the chip designers, that was a very lucrative market. They would design chips to enable them to sell more into that market. Chip design is now driven by cloud providers. So the major chip designers are building the latest and greatest and fastest and most performant chips for the cloud providers. And the cloud providers are getting all of those chips. So if you want to have the fastest CPUs, you need to be running your workloads in the cloud. And that trend will only become more true over time. So if you sit there and say, well, we are never going to run our software in the cloud, then what you are saying is that some of your competitors will run their software faster in the cloud. That's the first thing to think about from the overall trend. The second thing is to step back and think about what the cloud was originally designed to provide and what it's still, I think, at a ratio of probably something like 99-1, does provide, which is web scale request response style services. The web is characterized by you loading a web page, sending a request, getting a response back, going to Facebook, going to Netflix, these sorts of things. It's not characterized by what we see in capital markets, which is the real-time streaming of data, order entry or market data, for example, to you, to other people all around the globe. And if you're engineering systems at scale to support The first, the request response style architecture that I would call, you make very different engineering decisions from if you're trying to support the second. And it is absolutely the case that the moment, and over the last 4 to 5 years, the default cloud services that, for example, AWS provides as a first party service were not built and are still not built to target capital markets style use cases and workloads. Very low latency and high reliability market data, for example. But it is also the case that the providers, both AWS and Google, are spending money to make their infrastructure more compatible or more supportive of capital markets front office workloads. So there's a range of investment that AWS are making. AWS Outposts is a good example of something that is innovative in their space. They also have local zones, a range of services that enable you to improve on the default, shall we say, latency that the cloud provides. And those investments are only going to continue through the major partnerships you see, AWS and NASDAQ, Google and the CME, Azure and LSEG. You can't find a major exchange that doesn't have a partnership with a major cloud provider. It's all the direction that they're going in. So these technical constraints are being knocked down one by one. I truly believe that. We see that through our discussions with the cloud providers, and we think it inevitable that over time, market participants will find it simpler to move their workloads into the public cloud.
Awesome. And based on what you just said, it sounds very cool because, I come a little bit also from the capital markets background. When we speak about trading platforms and trading technologies, and we speak about regulators, one of the things that one of the big requirements that major regulators have around the world is disaster recovery. And arguably, there's so many things going on in the world today. In the mainstream media, we've had talks of like underground data cables being cut or something like this. It sounds like we're moving into a future where if something happens to the legacy or the fixed resources, right, the hardware, the servers and these kind of connections, if something, God forbid, happens to that, we can easily either supplement with the cloud or move some of this data flow and transactions and everything else into the cloud, because again, there's going to be so much interconnectivity between everything that it will be significantly easier. So in other words, if there is a major disaster event that technically you would think would impact trading or pricing on New York Stock Exchange, NASDAQ, DAX, or somewhere else around the world on the Nikkei, that might not necessarily be the fact, or the downtime might be shortened significantly because, again, systems can be basically as an alternative or as a supplement be placed into the cloud, let's say,
Yeah.
right?
No, it's a really good point. There's 2 points I would make there. The first is that the availability and resiliency strategies for financial systems in the non-cloud world, shall we say, I'm being flippant for effect. The strategy was really put all your eggs in one basket and hope. There are many, many major financial services institutions running very important parts of their infrastructure where they have a single point of failure, where if one network link goes down or one machine or one data center fails, they have a real problem. When you go to the cloud forces you to embrace the fact that there is failure across computer networks all the time. At any point in time, many things are broken and you have to deal with it. And that ephemerality of the underlying infrastructure is something that you then embrace at the software architecture level. And Aeron has, as part of its open source stack, Aeron Cluster, which is a very innovative way for you to provide very reliable services or applications on top of infrastructure that is less reliable than your service needs to be. So by embracing that ephemerality of the underlying infrastructure, what actually happens is that rather than building something less resilient, you build something more resilient because you build in the ability to handle all the different failure cases and the failure modes that you are confronted with, right? The famous engineering story here is from Netflix, who invented or came up with something called the Chaos Monkey, which was a software process that went around and just randomly shut down different servers within their environment in production to prove that they were handling the fact that those servers could themselves just shut down. That meant that they ended up with a far more resilient system. And it's that level of thinking that is not so much, well, we put all our eggs in one basket and we hope that no one trips over the cable. It's actually, we go and pull cables all the time to make sure that the system overall is resilient and available.
Great. Matt, I wanted to ask you if we can discuss a few case studies, namely
Absolutely.
the work that Adaptive has done for companies like Tradew, ADSS and EDX markets?
Yep, absolutely. So let's start with ADSS. So ADSS are a Middle East headquartered in Abu Dhabi retail broker, now owned by ADQ via their investment in ADX. So they're a large part of the Abu Dhabi financial infrastructure, shall we say, state financial infrastructure. And they're a retail broker that we started working with 4 or 5 years ago in mid to late 2000. And they had a desire to build a new novel, differentiated retail trading platform to serve the wider market that they existed in. They came at it from the perspective of wanting to build something really bespoke. They felt that the market was saturated. MT4, MT5, undifferentiated retail brokers were everywhere in that market, and they wanted to do something different. And so we worked with them to build out the ADSS trading platform. We built that with a combination of our technology, so a combination of Aeron, a combination of a development platform called Hydra that sits directly on top of Aeron, as well as a number of our professional services consulting, working very closely with their different stakeholders over the years to understand exactly what they wanted and how they wanted to build it. We helped them launch over the course of 12 to 18 months, starting from nothing to building the system, deploying into AWS, getting them live, trading their first trade, connecting with all their other infrastructure. And we run that platform for them today, and they continue to be a great client. And through recent change of owners, going from strength to strength and how they want to serve their market. It's a very interesting use case of a firm that wants to differentiate via technology. And that is a great example of the people we serve best. So as a technology vendor, we don't sell a single point solution. Like, we don't have a thing off the shelf that you buy and install that solves your problems. Instead, we have taken a bottom-up approach, starting with open source software that suits the financial services community, building a development platform on top, which lets you build out an actual business capability that sits on top of all of that stack with far less risk and far less time than it would take to do so otherwise. Tradu, or people may know them as FXCM, is another client of ours, a very good client that we're doing a lot of work for across a range of their different business verticals. And they have a growth strategy in mind that they're executing at the moment. They are bringing to market new capabilities, new product types, new offerings, and they're doing so in a very considered way, building out a platform, leveraging the vendor ecosystem that exists to serve different parts of the execution workflow, proving the point that they can grow into their market with that capability, and then circling back to take more ownership of the entire stack. So they are taking a very considered step-by-step approach. The CEO of Brandon is a very, very thoughtful guy who is thinking very carefully about how to piece together the technology that underpins his business. And that is a very considered mix of bespoke development, where they think they need to own something that really differentiates them in the market, and a vendor-provided service that they see as commoditized or undifferentiated, or perhaps, putting words in their mouth, perhaps very difficult to make money out of because it's such a competitive market, right? And if there's some part of the stack is highly competitive, perhaps the best thing to do isn't to go into it, but instead to leverage some of that competitive force that's driving down prices to build your own added service on top. EDX markets, an interesting one, an institutional cryptocurrency exchange. We have done a number of projects for them. One of the projects we did for them was build out their clearing system, which again targeted the cloud, targeted AWS, and they have gone from strength to strength. They came to market relatively quickly. And again, you'll start to see a theme here. The clients that we work with are really interested in having some control and ownership and differentiating via the technology that we provide them. And then finally, of the firms, I think you mentioned Kepler Chevreau, equities broker, French headquartered, but operates globally. They are users of Aeron and Hydra and are very forward thinking about the mix of public cloud and non-cloud infrastructure in the equities market. So the equities markets are not in the public cloud yet. And so you would be wrong to build all of your infrastructure in the public cloud to access those markets if you are concerned about latency. And so Kepler have a hybrid approach where they deploy a large amount of infrastructure in the public cloud. I think they work with AWS and then deploy some bespoke execution capability into all the data centers you would expect them to deploy to for latency and interconnection reasons with the equities markets that they operate in.
Mm-hmm. Very, 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 very interesting. And then I find it really cool, once again, that adaptive technology and open box software and some of these other custom solutions that you make, we're not just talking about front end or institutional trading platforms. We're talking about, like you just said, matching engines and all kinds of other things that are very, very important components for any kind of capital markets firm today.
Absolutely.
especially if they have business across many different asset classes, which is we know very, very popular today for a lot of firms, and also have a lot of different counterparties all over the place, whether it's liquidity providers, banks, hedge funds, and whatever it may be, which I think is very interesting because I personally, I always thought of Adaptive as a build it out of a box platform provider, and not necessarily a firm that can do all of these other more complicated software and an engineering task. So
Uh,
definitely,
that's right.
definitely,
Yeah.
definitely kudos to kudos to you guys.
Thank you.
I guess I want to really phrase this question to be specific about maybe multi-asset brokers or CFD brokers that Adaptive works with, and
Absolutely.
some of the feedback that you get from clients, potential clients. Is there a gap between what these types of brokers typically value in a trading system and what they should value from the perspective of the developer?
Good question. So first, let's talk about the different types of brokers that you can have in the market. There are brokers who have very successful businesses based upon an entirely what I would call undifferentiated or vendor provided stack. And they are differentiating themselves in their market through regional coverage, regional specialities, franchise, partnerships, sales relationships, all of what I would call the non-technical aspects of their business. Obviously, they are still a business running on technology. You can't be a CFD broker without a large element of technology in your stack. People are still logging into systems and trading on electronic prices. But that stack could be less under your control or less under your ownership than a broker that sits elsewhere on the spectrum. And if we talk about some of those brokers elsewhere on the spectrum, which I think you're thinking about, there has definitely been a shift in the last 5 to 10 years through one, the arrival of the public cloud as a suitable set of infrastructure to run a technology differentiated CFD broker. It was the case 20 years ago that if you wanted to run one of those businesses, you needed to have your own data centers and connectivity and infrastructure. It's very expensive. That really meant it was only applicable to the largest of firms who had the investment budgets and operating budgets to maintain them. Whereas today, the capital outlay is far less, and you can get a world-class system built and stood up for a fraction of the time and the cost that it was previously. And also through the arrival of open source software that solves for the particular quality attributes of these brokerage firms. So they have latency concerns, availability concerns. They need to be reliable, predictable. They need to be something you can connect to via either a mobile app or a desktop app with low latency prices being streamed to you, or via an API if that's also the type of market you're serving. And all of that technology stack used to be highly proprietary and would require a very large pool of engineering talent working directly for you to build out that stack. Now there's open source offerings. There is a different set of products in the market, including ours, that let you buy a whole part of the lower level undifferentiated stack. And if it's open source, I say buy. If you're taking open source, you can also choose to take support. And if you're a regulated entity, that might be what you're required to do. So you're still buying open source in a certain sense. That stack of open source software, proprietary software, none of which actually sits in front of your users. You just use that software yourself as a layer to build on top the differentiated piece through which you serve your clients and compete in the market. And so I think that there's a disconnect in brokers, as we see in all, it's not specific to brokers, don't get me wrong. If you think about who sits in the seat, makes the decision about business strategy, it is typically at the moment not someone who's come up through the engineering side. And they have very fixed ideas informed by their history of how much technology costs and what you can do with it for a certain amount of money. And what we see is that those ideas are becoming rapidly outdated. So what we see is brokers who have a different mindset, who have management layer having perhaps engineers in it or more affinity with engineering, are able to take advantage of the greatly lowered costs of technology that enables them to do something differentiating. So to come back to your original question, those brokers that are looking to do something differentiated with technology, they may value low-cost technology, whereas a competitor broker who's also looking to do something differentiating via technology may not value low-cost technology, they may value enabling technology. And those are two different things, right? Like you can get a relatively large amount of capability from a vendor for a low cost, but maybe it doesn't enable you to do anything different on top. Or you can get a relatively smaller part of your stack for, say, the same cost, maybe more, maybe less, but what it enables you to do on top is far greater. That mindset shift or that mindset difference we see is very critical. Obviously, we work best with the latter, the people that want to be enabled to do something via technology, than with the former. And it's really about valuing the technology of the trading system and what it can bring you, or valuing the enablement that the technology can bring you as an engineering firm or as a developer. And that is a big shift, or a big split, I should say.
Thank you. Those are very valuable insights. And I think that kind of segues well into my next question. Specifically, for brokerages looking to modernize their infrastructure, what's the tipping point where building custom technology becomes a better option than buying off the shelf? And I think
Yeah.
maybe you partially kind of touched upon this in your previous answer, but if you can kind of delve into this for our listeners.
Yeah, absolutely. So apologies. I'll again divide the broker community into into two. It's how I think about it. There are brokers looking to replatform. They have an existing business and they're looking at, and there's a reason for change. And then there's firms coming into the market fresh with no legacy, right? Starting a new business
Yep.
with some maybe being spun out or given some seed funding from somewhere. Those firms looking to replatform are typically driven by a couple of different motivating factors. They will be experiencing their own competitive pressure, and they will feel that competitive pressure show up in their business in a couple of different ways. They could feel it through their inability to get more differentiating features out to market. They might think that if they could only get this new capability or this new product type into their platform, that maybe they would be able to grow their revenues more and win more market share from their competitors. Or they may conversely think, God, we could be more profitable if we were just doing what we were doing, but paying away less of our revenue to the technology vendors that were enabling our offering, right? And they may come to different conclusions about the pressure that they're under. If you're motivated simply to have more control, then it's obvious that you don't go from one vendor landscape to another vendor landscape. You look distinctly at a different way of doing it, and you might put in place a CTO with more control, maybe put a CTO on the board or at your executive committee and give them more oversight and control of the strategy of the business. And that CTO, based on their experience, might choose a set of vendor provided products, development platforms, or open source software with which to deliver the overall business goal. We find that because we have Aeron as an open source foundation, many firms come to us, many brokerage firms come to us because they've already started doing some work with Aeron, right? They're like, we're going to go down the more technology-led road here, do some research, do some reading. Oh, Aeron seems to be widely used. They maybe come to a community event that we run. They don't speak to us. They just show up. Then 6 months later, they say, we've built this technology stack. Could you help us support it or do more or go further or go faster or so on and so forth? Then we get engaged with them and they can leverage a development platform that sits on top, leverage our training, leverage our support, do whatever. And they are looking to de-risk and accelerate. So a well-proven open source platform means you can hire developers that understand the tech stack that you are building on, which is a very important consideration, right? Moving it from vendor provided software to software you develop yourself, it's not the grass is greener, right? Now you have to manage engineers and developers. You have to have technology that people want to work on, that they find interesting, that they think furthers their career. There's a whole different set of challenges you need to deal with. So open source really happens there. I think you asked about the tipping point. The tipping point is when the cost benefit ratio gets to the point where people can see that despite the risks of going out and embarking on a new venture, the benefits of owning more of the technology stack outweigh the risks of where they're coming from. And the risks of where they're coming from are typically inertia, right? Like if we stay where we are, we're never going to grow. In fact, we might start losing market share and then there's a downward spiral that begins. But the benefits have to be pretty clear, right? You have to be able to say, look at how much we'll be able to build for far less cost. Look at the features we'll be able to build. Look at how we perceive the value in the market to be of those features. Like you really have to believe that there's differentiation that will win you business, right? Once all those considerations are taken into consideration, you end up not so much as at a binary tipping point. It would be nice if it were so, like one day it's 100% clear you should do this thing, and then the other day it's 100% clear you should do this thing. It's far more of a scale, and people begin the journey not necessarily clear about where they're going to land, but just knowing that the overall direction of travel is the right. And I think they do so sharing our view that liquidity and venues are moving into the public cloud and that they should build their trading infrastructure on AWS, and that they should think about what the landscape of the connectivity ecosystem is going to look like, not today, not in 6 months' time, but in 4 years. And when we speak to clients about this, one of the refrains we hear quite frequently is, look, everyone knows we're all going to be in the public cloud in 15 years. No one knows how to get there. It's really true. No one knows the steps along the path, but we all know the destination. And so people are beginning to make significant bets on the fact that that's where they're going to go. That's the pull that leads to the tipping point, and then the push is like vendor frustrations and unable to get the functionality you want, and the typical things that you hear in any industry actually.
Yeah, I completely agree with you just from personal experience. To get all of the stakeholders to buy in to something like this, where it's like, well, listen, maybe our legacy stuff is outdated or again not competitive anymore, because at the end of the day, if it's a legacy system, you mentioned this, we all know this, you have to have in-house staff, they all have to be well versed in code and the technology that you have. It's very difficult to scale legacy technology without very big capital infusions, right?
Yep.
And again, if you're in a large firm, if you have a lot of executive stakeholders, again, you have to put everybody's minds at ease. You have to make sure that everybody's on the same page. Otherwise, at the end of the day, there's not going to be this sort of overall confidence in where you're moving in terms of trying to move forward in terms of the technology. So,
You hit on a very good point there. If a shift to the cloud is seen as a purely IT or technology driven initiative, there is no way it can render to the business the outcomes that would otherwise be possible. It really needs to be seen as an enabler of a very distinct set of business strategies. And if it isn't, if it's like, well, every time IT tells me they want to do a project, it takes longer, it's more expensive, and it's never as good as they thought it would be. If it's seen in that light, then it's very difficult to get buy-in. If it's seen as, no, no, this totally changes our operating model and it affects every single department in the organization, and it affects the market we can address, and it affects the quality we can reach, that deserves board attention and is typically the way you'll see success.
absolutely, absolutely. Matt, before we wrap things up, I wanted to sort of get your perspective on the future and looking ahead when we speak about technology shifts, whether in messaging protocols, infrastructure, or user experience, which I think
Mm.
is also a very important thing. Do you think that brokers aren't preparing for some of these individual things, or are they missing out on something when they're thinking of the future and what to expect? I mean, like you just said, everything's going to move into the cloud in let's say 15 years. But as we progress on that journey, what should firms look out for or think about that they might not be thinking about today?
I think it's difficult to reduce it down to a single point without sounding a little bit trite and a bit reductive. But let me do my best to sound either not trite or as trite as possible, um, depending on your perspective. I think the thing that the brokerage community needs to get ready for is an ever increasing amount of change and disruption to their existing business models, whether that be through regulatory change, through geopolitical shifts, through the approval or disapproval of entirely new asset classes coming into market and more quickly being accepted or not accepted or deregulated by various industry regulators. I think they should also get ready for more disparity between regulators than we've seen over the last 10 to 15 years. I think the geopolitical world is changing. We are at the very beginnings of what that will look like. But one thing I do hear from other firms in the ecosystem, be they exchanges or investment banks or buy-side firms, so the spectrum is that they are expecting there to be more regulatory divergence rather than less, which is a change in approach. And that means that brokers should be setting themselves up for the ability to be agile and flexible about where they need to be in 2 to 3 years' time. They need to probably think about being able to make smaller bets more frequently than larger bets that take a longer time to come off, because the time cycle of change is increasing, right? Change is becoming more frequent, and change that impacts their businesses is becoming more frequent. Therefore, if someone comes to you and says, oh, we have a 3-year plan, it's like, it might be a great plan, it might even succeed, but where you think you need to be in 3 years' time is probably not where you do need to be when you get to that point in time in 3 years. So resisting the temptation to make long form bets and instead living with shorter bets, despite the fact that they may be limiting, is probably the right thing to think about.
Great. Matt, before we completely wrap it up, I always ask my guests a personal or maybe humorous question. You
Mhm.
mentioned you're from New Zealand.
Yeah.
When Matt retires, is Matt going to go back to New Zealand with your family, perhaps, or is there another part of the world that's kind of captured your heart? And
It's a very good question, and to answer it very personally. So, my wife and I are currently spending our time between the adaptive office in the UK, the adaptive office in the US, and our other offices around the world. And we're very fortunate that my wife and I are able to travel. So I'm in New York at the moment. I'm here for 2.5 months, 2 months. I go back to London for summer. We have a 2-year-old, and we have never been more uncertain about where we're going to be in the future than we are right now. So
nice.
when people say to me, "Are you ever going to go? Are you ever going to go back to New Zealand?" I say, "Well, ever is a long time, but I can't see it happening in the way I think about my life at the moment. So there need to be a change in how I think about my life for me to commit or say that I will actually end up going back to New Zealand.
It'll definitely not be before everything moves into the cloud,
It will definitely not be
right?
before everything moves into the cloud. That's right. Right, Nick.
Great, great. Well, look, my impression of New Zealand, I've never been there, but my impression is it's quaint, it's quiet, it's nice. There's sheep, green grass. So,
And
in terms of
if
retiring, it seems like a great place to
if
go.
it is like that, and if that is what you want, it is wonderful. And
Uh-huh.
if that is not what you want, it is pretty unpleasant.
Yep, yep, makes sense. Of course, makes sense. Matt, well, thanks for taking the time. I know you're really, really busy. Like you just said, you're working out of different offices around the world. I wanted to thank you for joining me today, giving me all of these valuable insights about Adaptive, about the way that you guys work, a lot of the discussions that are happening in the public space, and sharing some of your use cases with some of your customers. I think it's definitely a very interesting time within the capital markets or financial markets industry globally. I wanted to wish you and Adaptive the best of luck as we move through this period. And I hope to one day meet you in person or perhaps catch up with you on another one of our virtual sessions, whether it be a video interview or some other discussion.
That'll be great, Nick. I hope to meet you as well. It's been a really good discussion. Thank you for the very enjoyable questions. I've really enjoyed it.
It's great. Thanks. You're welcome and have a great rest of your day.
Thanks, you too.
Cheers. Thanks for listening to our latest Finance Feeds podcast episode. For sponsorship opportunities or to become a guest, please email us at info@financefeeds.com.